Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're going to be talking about how to utilize your equity portfolio to generate an income stream for your portfolio. Now, one of the reason I want to utilize this topic is because I think a lot of us are looking for income, especially in this lower interest rate environment. However, I don't think everyone realizes just how important or just how useful your equity portfolio that you currently have is for generating income, and how you can leverage your equity portfolio to generate an income stream for your portfolio. And options is a great tool to be able to allow you to go about to generate income. So I want to break down what type of strategies can you utilize your equity portfolio for to generate an income stream, and hopefully provide this in a context that any equity investor, whether you are a stock investor, ETF investor, whether you trade short-term, long-term, anyone with equities in their portfolio can consider utilizing options to help them generate income. And it's really useful regardless of whether you are an options trader or not, because the strategies that I'll show you here today really have very little to do with options. It really is around your equity portfolio, everything to do with helping you buy the stocks that you want to purchase in your equity portfolio, and then eventually sell those stocks, hopefully at a profit. And options really allow you to buy and sell your securities, but do so in a way that generates income. And that's how we want to show you these strategies today. And I want to go through as many examples as possible and show you the tools that you have available to you in order to generate income on your portfolio. So before I do that, just a little bit of housekeeping. For those of you that are brand new to Options Play, welcome. If you don't have access to the platform yet, you can sign up for a free trial using the link here on your screen, which I will post into the chat window so that you can sign up, which gives you a free 30-day trial to the tools that I'll show you here today. Including membership is just $75 a month or $500 a year after that 30-day trial. And if you sign up today, you get a free 12-step options trading course to help you get jump-started in your options education, as well as daily options trading ideas emailed to your inbox every single day. So I hope that if you're brand new to Options Play, to sign up and take a look at the tools that we have to show you here today. And just a quick announcement for those of you that didn't see this last week, I recently signed with CNBC to be on their Options Action show every single Friday at 5:30 p.m. So I hope that some of you will be able to watch that show and learn a little bit more about some of the strategies that I teach and some of the actual ideas that I send out to you guys, being able to see that on CNBC. Thank you so much, Laura. So let's go ahead and get started. Number one, we're going to cover quite a few different things, but I'm going to try to spend as little time as possible on the slides. I'd rather spend more time on the actual examples, because I think the best way to learn is by looking at the examples and also giving you guys an opportunity to show me what symbols you're trading or what stocks or ETFs you're buying or selling, and taking a look at how you can utilize options to buy and sell those securities while generating some income. So today we're going to cover two different option strategies that are suitable for this particular topic. I want to talk about what are those two income option strategies. They are cover calls and cash secured puts. Not difficult strategies to understand, relatively simple strategies. But for those of you that are equity investors, I don't even want you to think about these as option strategies. I want you to think about these strategies as ways to augment your existing stock position. So before I get started, how many of you here invest in stocks or ETFs? Please type yes into the chat window. If you do not invest in stocks or ETFs, please type no into the chat window. You can find your chat window at the bottom of your screen. So yes, if you invest in stocks or ETFs, and no if you do not invest in any stocks or ETFs. Okay, predominantly yes. I have a few no's here. So for those of you that do not invest in any stocks or ETFs, I'm curious as to what it is that you invest in. If you only trade options, And even if you only trade options, you can still take some of the strategies that we'll show you here today, and you might just turn them into credit spreads instead of selling cover calls and cash secured puts. So I will say, for those of you that say that you do not invest in stocks or stocks or ETFs, this might not be the right webinar for you, because the ability to generate income utilizing options predominantly requires you to have an equities portfolio. So either stocks or ETFs. You need to have those strategies, or maybe you want to purchase those stocks or ETFs in order to generate income. And I want to explain why your equity investments provide this huge opportunity for you to generate income. And when we go through some real examples, I think it'll become more apparent as to why your equity investments are so useful in helping you generate income. Then we'll talk a little bit about what are the optimal income strategies. So how do you actually go about selecting expiration dates and strike prices based on our back testing? How do you go about selecting the optimal strike prices for cover calls and cash secured puts? What are the methodologies behind them? And talk to you through it, why we choose certain strikes and expirations and why they make sense. And lastly, like I said, I want to show you how to automate these strategies using options play. And I will walk you through the weekly cover call reports that we send out currently. This is something that we currently do every single Monday morning. So for those of you that are subscribers, you've probably seen these reports that we send out. I'll go through those reports very quickly so that you guys can get a sense for how to utilize them today. So I'm going to start off today talking about cash secured puts. And the reason that I'm going to start off with the cash secured puts is because most options income education that you see out there will always start you off with cover calls. But the reason I'm not going to start off with the cover calls is because cover calls means that cover calls require you to already own the stock or ETF. But we don't start our portfolios with stocks and our ETFs. We have to buy those stocks and ETFs in order to sell cover calls. So I think what I want to do is start off by talking about what is a short put, because a short put is a strategy that allows you to purchase the stocks that you want to own in your portfolio, whether they're a stock or ETF, but do so in a way that allows you to acquire these shares at a discount. So think about that. What if you can acquire every single stock or ETF that you own in your portfolio with a discount? What does that do for your portfolio? And what if you're able to not only provide a discount on the purchase, but generate yield on the cash that you're utilizing to try to buy these stocks? Because as an equity investor, you're probably familiar with placing a limit order, setting aside cash for that limit order, and waiting for a limit order to fill on a stock or ETF position that you're looking to purchase. If you've ever put in a limit order to buy stocks, please type 1 into the chat window. Because when you place a limit order, you have to set aside cash that will be used to purchase the stock when the market hits your limit price. Now, that cash that you're putting aside actually is not generating you any yield. So a short put is a way to give you the same obligation as a limit order, but give you some income while you wait for that order to get filled. So next time you think about buying a stock, consider selling a put instead, because when you sell a put, just like a limit order, it obligates you to buy your stock at the strike price upon expiration, just like how you're obligated to buy the stock at the limit price once the stock hits that price. Now, there are some differences between the strategy. Number one, this short put typically only executes at expiration, versus a limit order will get filled immediately once that stock falls to that price. So there is some patience that you need to have when you're selling a put option versus placing a limit order. So depending on how much you're trying to chase that stock or how important it is for you to get filled immediately, there are some differences between selling a put versus placing a limit order. And I want to be very clear about that. However, by selling a put, even a single put over typically, let's say, a 3 to 4 week period, you're going to see that you're able to acquire shares usually at about a 50 to 100 basis point discount. So 0.5% to 1% discount on most stock purchases by selling a put option instead of placing a limit order. And selling a put does require you to trade in 100 share increments. So higher price stocks, if you don't have the capital to sell a put, might not be a strategy for you, but on the lower price stocks you're looking to acquire or ETFs, many times this is, in my opinion, a better way to acquire your shares at a lower price. And to sell these puts, it requires you to have cash or margin in order to sell that put, just like a limit order. When you place a limit order, you need to have the cash on hand in order to place that order. Same thing with the put. You need the cash or margin on hand in order to sell that put for the 100 shares. And yes, just like a limit order, you can cancel, just like how you can cancel a limit order anytime, you can buy back a put before expiration. If you choose 2 weeks into the put or a week into the put or even an hour into the put, you decide that you no longer want to buy the stock at that price, you can always buy back the put. So you're not obligated to hold on to that put through expiration. Now, once you sell a put, there's two possible outcomes. Just like a limit order, the stock can either stay above your strike price or below your strike price. Same thing with the cash secured put. If the stock stays above your strike price, you actually keep the income that you received on that short put, and you can sell another put. So if you, just like a limit order, if you put in a good till cancel limit order for 30 days and it doesn't get filled, you can place another good till cancel order. You can think of the same way as selling a put that has an expiration date. But the difference between a limit order and a put is that by selling the put, you receive some income, so that the cash you're putting aside to try to buy that stock is not just sitting there, it's yielding you some income. And if you choose after that expiration to sell another put, you can generate more income. And that's the income stream that you're trying to generate on every single stock purchase going forward. Now, if the stock does go below your strike price, now what happens is you own the stock at the strike price, which is the price that you wanted to buy the stock at, minus the income that you receive. So that's a discount factor that you're going to receive on your stock purchase, is the income that you receive. And I think the best way to understand this is to go through some examples. I'm going to go through an example here in just 1 minute, okay? So the goal here is to help you acquire your shares at a discount. So let's actually jump straight into options play and let's take a look at some examples. Normally I like to go through all the slides, then I go over to options play. Today I'm going to change things up a little. I'm going to go through the second we teach this concept, we're going to go into the options play tool. Now, before I show you guys some examples, I just want to make sure everyone understands this concept of selling a cash secured put to purchase your stocks at a lower price. So if you understand that, please type 2 into the chat window, and I will go through some examples to hopefully help illustrate this process a little bit. So perfect, I see a lot of 2s. So why don't you guys submit some symbols of stocks or ETFs that you want to purchase, and we'll take a look at it together. So the options play tool itself is broken down into 3 sections. You have trade ideas, watch list, and portfolio on the left-hand side. In the middle is our security analysis panel. On the right-hand side is trading and income. So today we're going to focus our attention on the income tab, because that's what we're here to do, right? We're here to generate income. And the income tab is really designed to help you quickly narrow down exactly what strategy and what expiration date and strike price makes sense for you. And I'm going to come back after we go through some examples to talk to you through why we choose certain expiration dates and strike prices. So I got a lot of symbols here. So let's take a look. I'm not, obviously, unfortunately, not going to be able to go through all of them, but let's take a look. Jacques wants to look at BRK.B, Berkshire B. He wants to buy this stock. So Berkshire B is trading at 228. If you wanted to place a limit order, you would place a limit order at the price that you want to purchase the stock at. So here, the stock's trading at 228 right now. On the income tab, you'll have 2 choices. You can either say I own shares of Berkshire B, or you can say no, I don't own shares of Berkshire B. Because we're trying to acquire these shares, I'm going to select no. And as you can see here, it's telling me to sell the January 31st 225 puts. So the stock is at 228. 225 is about $3.50 below the current price. So think about placing a limit order. If you wanted to place a limit order at 225 to buy the stock, you would have to set aside $22,500 to place that limit order. When you sell a cash secured put, you only have to put up $22,382. So that reflects the $118 income that you receive from selling this put option, which, as you can see here, is a 0.52% discount factor in just 22 days. So in the next 22 days, if the stock goes below 225, you will able to buy it with a 0.5% discount, and $118 discount for every 100 shares. And even if the stock doesn't decline to 225 and this put expires worthless, you've yielded 8.56% yield on your cash, because $118 out of $22,382 over the whole year, once you annualize it out, is 8.5% yield on your cash. So even if you don't end up owning the stock, you've gotten about an 8.5% yield. That's significantly higher than most other income-related products that you see out there, right? And this is really what you can do for any stock that you want to own. So Ed wants to look at Beyond Meat. Now, Beyond Meat's a really volatile stock, currently trading at $90, had a big pop today. I think possibly on the McDonald's news. But let's say we wanted the Beyond Meat's at $90. So here to sell a January 31st $84 put. Now this is further away because this is a much more volatile stock. That's why we've selected a strike at 84 when the current stock is at 90. And as you can see here, if you place a limit order to buy 100 shares of this stock, you would have to set $8,400. But instead, by selling a cash secured put, you only set aside $8,122, which reflects a $278 income that you receive on this put option, which is a 3% discount. That is a huge discount. Now, I will say this is not typical. This is because Beyond Meat is a very, very volatile stock, so you're going to receive higher premiums, but that's a 51% yield on your cash, meaning if this order does not go executed in the next 21 days, meaning Beyond Meat's not below 84 by January 31st, you've yielded 51% yield on your cash that you tried to purchase this stock with. If you had placed a limit order at 84, you would be paid $0 for it. This is the type of yield that you can receive from selling cash secured puts to purchase the stocks that you want to buy. Now, I see a lot of different symbols in there, but I'm going to take the ones that I see more commonly. I see Pfizer from Susan and Christopher. I also see quite a few I'm going to try to pick some stocks that people, first of all, are big cap names so that most people recognize, but also ones that multiple people have asked for. For Pfizer, $38.89 currently trading. This is telling me to sell the January 31st $38 put. So trying to buy the stock at $38. Normally, you'd have to set aside $3,800 to buy 100 shares. Here, you only have to set aside $3,750, reflecting a $50 discount on this purchase, which is a 1.29% discount, or an annualized yield of 21% on your cash. So that if you own the stock, you own it at a 1.29% discount from $38. Or if you don't own the stock, you've yielded yourself 21% yield on your cash. You can choose to redeploy that cash on another stock or on Pfizer stock again, but that's your choice to make on January 31st after this put expires. You either own the stock at a discount, or you can now redeploy that cash either in a different stock or on the same stock, but giving you a significant yield on your cash as you wait to deploy it. And I hope that this is showing you the type of returns that you can expect. Let's look at Apple. I saw quite a few people wanted to look at Apple. Now, I find it difficult to chase a stock that's had such a big run. But if you want to purchase Apple, let's take a look. Apple's trading at $309, almost $310 right now, selling the January 31st, $297.5 puts, yields $480 in income, which is 1.55% discount factor. So to purchase 100 shares of Apple at $297.5, you would have to set aside $29,750. Here, you take $480 off of that, meaning you only have to set aside $29,280, so that if the stock does go below $297.5 by January 31st, you own it with a 1.5% discount, a significant discount. Imagine being able to get a 1.5% discount on every single stock purchase. What does that do for your portfolio? But moreover, if you don't own that stock, meaning this stock continues to rally, or maybe it just doesn't go below $297.5, you've yielded 25% yield on your cash. that's a significant amount of yield in your portfolio. And this is the type of strategy that you should consider utilizing for the stock purchases that you want to make. So now that we've talked about the scenario, selling a put option to potentially buy the stocks that you want to buy at a lower price, now we can start talking about cover calls. And for that, I'm going to jump back to the slides. Now, a cover call is a strategy for the stocks that you now own in your portfolio. Now, we usually position cover calls as a income generating strategy, but I actually do not believe that that's necessarily a fair assessment of what a cover call is really designed to do. In my opinion, a cover call is really designed to help you take profit on your stocks as they rally significantly. So think of cover calls as a limit order that gets you out of your positions when the stock rallies significantly. Now, it just happens to be that by selling cover calls, you do get some income. Sometimes that income is significant, but compared to the cash secured put, the yield on a covered call is generally significantly lower. Now, there's a couple of reasons for that, but I'll get to that a little bit later. But the idea is that you want to sell a covered call on a stock that you own near a target price on the existing stock position. So think about the stocks that you own in your portfolio today. Think about where you would like those stocks to rally to in order for you to take profit and get out of those positions, because that's why you own those stocks, because you think it's going to increase in value and you want to be able to profit from that value. So cover calls allow you to take profit on your positions. Now, when you sell a cover call at the target price on your existing stock position, you have an obligation to sell the stock at that price if the stock's above that price at expiration, just like a limit order. If you place a limit order and the stock goes beyond that level, you are obligated to sell your stock at that price. Now, when you sell a cover call, just like the cash secured put, it does require you to trade in 100 share blocks. So whenever you're selling a cover call, you must trade in 100 share blocks, and they only typically execute at expiration. So you could have a stock exceed your strike price before expiration, come back below that price prior to expiration, and actually not have that order being filled. But again, unlike a limit order, you get paid yield if that call or put expires worthless. So it doesn't just go worthless. One of the things that, a lot of people will say, well, on a cover call, if it exceeds my level but comes back below, and I don't get to take profit, yes, you don't get to take profit, but you get to keep the income. And that income, again, is the stream that you're looking for. And at expiration, you have two possible outcomes. Just like the limit order, the stock can be above the strike price or your limit price, or it could be below your strike price. So if the stock is above the strike price, you've sold your stock at the target price that you expected to, and you receive some income to do so. If the stock is below the strike price at expiration, you can do this again, just like the cash secured put. You can rinse and repeat for additional income. And what you're going to find is that when you're selling cover calls, probably 4 out of 5 times, what's going to happen is it's going to expire worthless and you're going to do it again. And that is really a much more consistent income stream. So the best way to think about it is a cover call generates, in my opinion, a much more consistent income stream for your portfolio. Cash secured puts, it's not as a consistent income stream, but they tend to be higher amounts of income. So that's the two ways, in my opinion, that you want to think about cash secured puts and cover calls. So with that, I'm going to take those same stocks that you guys just provided me with. I'm going to go back to options play, and now I'm going to show you what if you own those stocks and now you wanted to sell a cover call on it. So let's say Apple. Let's say you own Apple, and I think many of you probably have this in your portfolio. So let's say you own Apple, and we think we own the stock because we believe it's going to continue moving higher. So let's take a look at selling a cover call. A cover call, like I said, is like a limit order that you place above the current price that you're hoping that the stock rallies sometimes in the future so that you can hit that price, take profit on it, and move on to the next trade. So here, this is telling me to sell the January 31st, 332.5 cover call on a stock that's currently trading around 310. So about $22.50 above the current price. And as you can see here, what I'm receiving here is a $269 income versus on the cash secured put, I was receiving almost $500 on the covered call, I'm receiving roughly half of that. Now, again, this is partially because of the fact that when I'm selling covered calls, I'm going to sell a covered call that's generally further away from the current price than the cash secured put. And I'll explain why that is the case in a few minutes. However, I want to first walk you through an example. So selling this 332.5 covered call generates $269 in income, which is a 0.87% of the underlying stock price. So think about this. If you own 100 shares of Apple, you would receive roughly $77 in income every quarter from the dividend. Here, you're receiving $269 in just 22 days. So that's why the dividend yield on Apple here is only 1% versus the yield on the covered call here is 14%. So you've increased your yield on Apple stock from 1% to almost 15% by adding covered calls to that. And this is yield that you're going to get just by waiting for your stocks to rally so that you can take profit on it. And these are the types of yields that we're seeing. So I'll take a look at some other examples that someone threw out there. Tesla, I saw a few Tesla examples. Now, Tesla has had a spectacular run, if you can even call it that, over the last couple of months. It has literally hit the stratosphere in terms of price. So let's take a look at some examples here in Tesla. Now, this is a relatively large chain, so let's give this 1 second to load. So let's take a look at this. This is telling me to sell a January 31st, 565 covered call. This stock has rallied $150 over the last month, and this is saying that it could maybe go another $80 to the upside in the next 22 days. But look, $830 in income in just 22 days on a stock that pays you zero dividends. So if you own the stock, you're getting paid nothing. Here on a covered call, you're getting paid $830 in just 22 days, which is 1.72% of the underlying stock price, which annualizes out to 28% yield just waiting for your stocks to rally. So if the stock does rally to 565, you are getting an additional 1.72% on top of the capital appreciation on the stock. If it does not reach $565, you've gotten an additional 28% yield on the stock that you own. And this is really where why I named this specific title of this webinar, Generating Income Using Your Equity Portfolio, because the assets you own in your equity portfolio is the biggest asset that you have to help you generate income. The stocks that you own can be utilized to generate a significant amount of yield that 28% yield doesn't exist anywhere else. Doesn't exist in the fixed income world, doesn't exist in high yield, doesn't exist in some of the higher yielding dividend stocks. It just doesn't exist. And these are on stocks that you very well probably own in your portfolio. I'll go through a couple of more examples here. I'll do Costco, a stock that many of you probably own in your portfolio. Costco had a pretty big jump today. 200, but as you can see here, telling me to sell the January 31st 307.5 covered call on the stock that's trading at $299, yielding me $129 in income for the next 22 days on a stock that pays $65 in income for every single quarter. Here, I'm receiving basically double that in just 22 days, which isn't very high, but as you can still see, yields, it's about 7% yield on these assets. So think about the amount of money that you've poured into the stocks that you own, right? And that cash, that money that you've poured into, what does that money show you? That money gives you two possible outcomes. Number one, a dividend yield if that stock pays a dividend. Number two, capital appreciation if that stock rallies in the future. Now, here you can think about the assets, the cash that you're pouring into all these stocks and ETFs, generating some yield for you. And that's exactly what options do. Options allow you to take the cash that you either are trying to acquire shares by selling cash secured puts and generating yield on that cash, or the cash that you've already purchased stocks with to also generate yield on that cash, those assets as well. So options really allow you to get coverage of income streams on both sides for the stocks you want to purchase and the stocks that you have already purchased. And I'll go through one more example before we go back to the tool. Let's look at AT&T. And I want to use AT&T because AT&T is a high-paying dividend stock. Let's take a look at AT&T. Fairly low price stock too, so many of you that own this probably own at least 100 shares. Many of you probably own hundreds of shares of this stock. It yields 5.28%, which is a very high yielding stock from a dividend perspective. But look at a covered call on AT&T. January 31st, 40.5 covered call generates $25 in income in 22 days on a stock that pays you $51 every single quarter. So how does that compare? The yield on this covered call is almost double what you're receiving on the stock itself. So think about all the cash that you've poured into AT&T stock. That cash is yielding you 5.28%, which is really good. But if you sold covered calls on top of it, you can generate another 10% on top of that, which brings your total yield on AT&T up towards 16%. So this is the type of income that you should receive. And a lot of people do not realize that the cash that you've poured into the stocks and ETFs that you want to buy can still be utilized to generate more yield for your portfolio. And many times I hear from users that sell covered calls, they do it from time to time when they remember. They don't think of it as an income generating stream for their portfolio. So you really should think about when you're doing these types of strategies to do them every single month, because that's how you're going to be able to generate 15% yield on your AT&T stock. If you're only doing it 1 or 2 months out of the year, then you're maybe going from 5% to 7%. But if you do it every single month, look at the types of yields that you can generate. And a lot of people come to me looking for income, especially those of you that are older, that are looking for stability. Income is very important, and dividend yields many times do not cover it. The S&P average yield is 1.8%. Looking at these covered calls, they are significantly higher than that. And that's really how you should think about these types of strategies. So I hope that this illustrates for you, number one, the power of these types of strategies for your portfolio and how to go about thinking about income generating strategies utilizing options. So with that, what I'm going to do is, instead of going through these XYZ examples, I've shown you some real examples. I think the best thing to do is really talk to you why we select certain expiration dates and strike prices. Once you understand that, I think that helps you have the knowledge to be able to start doing some of this yourself. So whenever we're talking about cash secured puts or covered calls, you have to select two things: an expiration date and a strike price. So as far as expiration dates, we looked at, I have 3 categories: short, medium, or long term. So what you're going to see is that the further out in time you go, the less certainty you have in terms of what's going to happen between now and expiration. And in exchange for that, you're going to get more income. If you choose shorter dated options, you have a lot more certainties of what's going to happen between now and that expiration date, but you're going to get less income. So the question becomes, where should you choose on the expiration dates curve as to where you want to sell covered calls? Now, generally speaking, I will say I tend to find that a lot of users gravitate towards more income, right? Because why wouldn't you want more income? Everyone wants more income. But but when we did the research here on selling these types of strategies, when we back tested all the different scenarios, we generally found that it's much better to sell these shorter dated options, so these short-term options, in the long run for more income. And the reason for it is because of 2 things. Number one, we generally found that whenever you're selling these types of strategies, covered calls, cash secured puts, or even credit spreads and iron condors, is that it's generally best to avoid selling these going into earnings. So when you sell a 1-month call, you can do that 12 times a year. But we know that there's 4 earning cycles throughout the year. So if you sell 1-month calls, you can avoid the 4 months when there's earnings and still sell the other 8 months of the year. If you choose to sell a 3-month call where you are getting more income for it, but because you can only do that 4 times a year, every single call that you sell has this large uncertainty factor built into it. So one of the ways to avoid that is to sell shorter dated calls that allow you to have a lot more flexibility as to when you want to sell and get coverage most of the year and avoid when you have earnings coming up. But the primary reason why you want to sell short dated options is because the premium that you receive on a covered call is not linear to the amount of time that you're going out. Meaning, if you sell a 1-month call and you collect $1 for it. When you sell a 3-month call, you're not going to get $3 for it. You're actually only going to receive roughly $2 for it. So when you sell a 1-month call, and let's say you collect $1 for it, and you sell a 3-month call and you collect $2 for it, as you can see here, on a 1-month call, I can do that 12 times. On a 3-month call, I can only do that 4 times. So by selling a 1-month call 12 times, I'm actually collecting roughly $12 in income. $12 in income. On the 3-month calls, I'm collecting only $8 in income. That's why you want to sell shorter dated options throughout the year rather than selling longer dated options. So whenever you have the choice, now this does not mean that you have to sell weekly options either, right? Some of you maybe only are comfortable trading the monthly options because you feel that there's more liquidity there. You feel that you're more comfortable managing these positions once a month. There's many reasons why you might want to trade monthly options, but if you're choosing between a November and a December, or you're trying to compare February to March, always choose a shorter dated option because you're going to be able to generate more yield because you're able to do it more frequently throughout the year. So for whenever you're choosing expiration dates for both covered calls and cash secured puts, you want to lean towards the shorter end of the curve. Now, as far as strikes selection, this is where it does differ from the stock versus the options. So here, what I'm going to do is I'm going to actually use my fictitious example here of stock XYZ that's currently trading at $100. Now, let's say I want to buy this stock at $100 stock. Now, I can choose different prices that I want to place a limit order at, right? I could place maybe a 98, maybe a 95, maybe a 90. So the different levels refer to how far down I want to purchase. So many times you might find yourself in the scenario where, just like a limit order, you're trying to decide, well, where should I place my limit orders? Where am I comfortable purchasing it? The lower I go, the less probability that I have of owning that stock, because the stock needs to make a pretty big dip to hit that $90 limit order in order for me to purchase it. So we have conservative, optimal, or aggressive. Aggressive refers to these $98 puts. These are much higher strike prices that require a much smaller dip before my trade is executed. In exchange for that, you're going to get more income. When you choose a more conservative strike price, these are much lower strike prices. They require a much bigger dip of the underlying stock from 100 down to 90 before the trade gets executed. In exchange for that, for selling that $90 put, I'm going to get less income. So the question is, which one of these do you want to trade? And the answer, based on our research, is the more aggressive strike prices. And the reason for this is because the more aggressive strike prices, number one, provide you with a much higher probability of owning the stock. So the goal here is to have a high probability of acquiring the shares. That's why you're selling the puts. You're selling the puts because you want to own the stock. So you want to increase the probability of owning the stock by selling strike prices that are close to the current price. And the win-win here is that the higher price, the higher strikes, the strikes that are closer to the current price, also give you a higher income, which leads to a larger discount on the stock purchase if you do end up purchasing the stock, and a higher yield on your cash if it doesn't end up in a purchase, meaning if the puts expire worthless, you get a higher yield. So you really get a win-win when you're selecting short puts that are close to the current price of the stock. Now, when we talk about cover calls, that's when it's somewhat opposite. So let's take a look at cover calls here. So when we're talking about cover calls, same thing. I'm going to use that example, $100 stock. Now, in this particular case, I believe the stock is going to rally because I own that stock, right? I only own a stock because I think it's going to rally sometime in the future. So think about where you want to take profit on that stock. So on a $100 stock, maybe I might take profit at 105, maybe 110, maybe 115. So you have lots of choices as far as where you want to take profit, right? So a 105 is what I would consider a very aggressive cover call. A 110 is maybe optimal, and a 115 is really conservative, right? The higher I go, the less probability of the stock rallying that amount in the amount of time that I'm choosing. So whether that's a 1-month expiration or a few weeks expiration, the further I go, the less probability of that happening. So the higher strikes provide me with more upside, meaning the stock the stock can rally significantly further, meaning I will have more profits, but in exchange for that, I'm going to get a less income. If I choose a very aggressive strike, those are much lower strikes. This gives my stock a lot less room to grow before I take profit. But in exchange for that, I'm going to get more income. So the question is, where do I want to choose these strategies? And I'll back up 1 second to the puts real quick, actually, because I forgot to cover one thing. And the thing is just, delta and POW. So when I refer to, actually, let's use the cover calls. So when I refer to a 115 strike as conservative, how do I actually choose those conservative strikes? So we always use probability. We always use probability to choose our strike prices, and that's how we're able to get consistency. So when I talk about 115, these are very high strikes. This has only about a 10 delta or 10% chance that the stock is going to rally to 115 or higher, which inherently means that if I sell a 115 cover call, there's a 90% chance that that's not going to reach that price and that call is going to expire worthless. So that's what POW stands for, probability of expiring worthless. So the closer the strike price is to the current price, the lower the probability that that call is going to expire worthless. The further away it is, the higher the probability it's going to expire worthless. So for those of you that asked what POW is, thank you so much. I forgot to cover that. But POW tells us what is the probability of the stock reaching that strike price, or the inverse of that, rather, of what is this of the probability of that strike price and expiring worthless. So higher strike prices, lower probability, lower strike prices, higher probability. And the question again is, which one is best? Now, the difference between a cash secured put and a cover call is that in a cash secured put, you want to own the stock. In a cover call, what do you want? You don't necessarily want your stock to be called away. What you really want is you want to give your stock appreciation or room to appreciate so that you can actually take a significant profit on those rallies. So whenever you're selling cover calls, you actually want to choose conservative strike prices that are further away. And the reason for that is because you want to prioritize the capital appreciation of your stock. You've poured all this money into Apple stock, Costco stock, Tesla stock. Why do you do it? You do it because you think it's going to rally. You believe it's going to increase in value in the future. That's why you need to give your stocks room to grow before you take profit on it. So whenever you're selling cover calls, don't try to go for a more aggressive cover call that might collect a couple of more dollars in income, because what you're giving up is $5, $10 in income. In upside for the stock in exchange for an extra couple of bucks in income. It's not worth it in the long run. We see a lot of users typically go for the more aggressive strike prices because when they look on an option chain, they'll see that the 105s maybe gives them $5 in income versus the 115s only $2 in income. And they're thinking, wow, I'd much rather have $5 in income than $2 in income. But what you're forgetting is you're giving up $10 in upside for an additional $2, $3. And in the long run, that never works out. You're going to give up far more in upside, which is why you own the stocks to begin with. Don't exchange that for just a couple of extra bucks. Many times we see that and it's not worth it. So you actually want lower income because what it's going to mean is that it's going to provide you a larger gain in the underlying stock position, which is your core position that you have when you're trading these types of strategies. I just want to make sure everyone understands that before I move on. So please type 4 into the chat window if that makes sense to you. Why, when you're selling covered calls, you want to choose strike prices that are further away, and then when you're selling cash secured puts, you want to choose strike prices that are closer to the current price. Perfect. I see a lot of 4s. Great. So just to wrap up what we discussed here today, number 1, you want to acquire shares at a discount using cash secured puts. Even if you don't end up acquiring those shares, it generates a fair amount of yield on the cash that you're putting aside to try to acquire those shares. And then once you own those shares, you must start selling covered calls immediately. Now, I get a lot of questions from users, especially after we do cover call webinars, where someone will ask me, I bought a stock at $100. I've lost a lot of money in it. I've lost, maybe it's trading at $50 now. Should I start selling covered calls today? Because obviously I'm trying to get myself back to break even, and any amount of income will help me get myself back to break even? And the answer is, generally speaking, if you're down 20, 30, 40, 50% on a stock, it's usually a little late to start selling covered calls then, because you always can potentially lock yourself in for a loss. Sometimes people don't like to do that. So be aware that when you're selling covered calls, it only works if you start doing it immediately after you start acquiring the shares. So get into the habit of thinking about selling cash secured puts when you want to acquire a stock. And then once you acquire those assets, utilize those assets to generate yield for you. Why should you skip selling covered calls in a particular month? You're giving up income if you're doing that. Don't give up that income. Be consistent in selling your covered calls. Now, when you're selecting your strike prices, your expiration dates, shorter dated options help you maximize time decay, helps you maximize income, because you can sell 1 month calls 12 times a year, and that's going to generate more income for you than if you sell 2 month calls 6 times a year throughout the year. When you're selling cash secured puts, strike prices near the current price of the stock. Okay, when you're selling cash secured puts, strike prices near the current price of the stock. When you're selling covered calls, strike prices further away from the stock price. Not too difficult to remember, and Options Play does a lot of this work for you. And lastly, you want to avoid selling options going into earnings. So with that, what I'm going to do is I'm just going to briefly go back to Options Play. I want to show you again, just to reiterate, how we built this tool to make this as easy as possible for you, because regardless of what stocks that you own, when you click on the income tab, you can select your own settings here. So I've set short-term optimal for my covered calls, and I've set short-term aggressive for my cash secured puts, so that Options Play automatically selects short-dated options for me and automatically selects aggressive covered calls and more conservative more aggressive short puts and more conservative covered calls for me. And you should set up a watch list for either stocks that you own or stocks that you want to own, whatever symbols that you want to put in there, just so you make it really easy for you. Let's say, regardless of what your holdings look like or what stocks that you want to purchase, set up a watch list, because we made this so that you can click on any stock, and without having to pull up an option chain, you immediately know where you have opportunities to sell covered calls. So if you want to own PVH, you can immediately look at selling February 21st 100 puts in order to potentially own the stock. And if you're looking to sell covered calls, this is another feature that we've built, because sometimes you do a lot of work trying to find a covered call just to realize that something suitable doesn't quite exist. So we really built this in a way to make it as easy as possible. So this is telling me that it could not find me a short-term optimal cover call. It's found me a short-term aggressive cover call. And if you pull up the option chain, I'm guessing it's because on the 115s, it generates so little yield that's really not worth doing. So it really goes through the option chains and tells me whether there's an opportunity or not. If there is, so let's say I look at Philip Morris here, an $88 stock. Instantly, I get 2 green check marks. That's telling me that there are opportunities to both sell cash secured puts and cover calls on Philip Morris. But on other stocks, maybe like Sprint, a very low price stock, many times you're not able to find this. Oh, actually for Sprint, looks like I'm able to find one. Normally, I'm not able to. But really, it allows you to type in any symbol, use your watch list, very useful, so that you're not wasting time. A lot of times I hear from users saying that they're not consistently selling covered calls month after month is because the amount of time it takes to pull up an option chain, go through the process, figure out which one to sell. With Options Play, we really built this in a way so that it should take you no more than a few seconds to find that cover call opportunity and go ahead and execute them. You should get into the habit of doing this Monday morning. This is when we send you these cover call reports. And I know someone before said that they were not receiving it even though they were a subscriber. So if you could send me an email at info@optionsplay.com, I'm happy to look into your account and to see why you're not receiving it. But this report also, again, is sent on Monday morning at 10:30. When the market's open, we scan for opportunities on Monday morning, and we send it to you also as a reminder to say every single Monday after options expiration, this is the time to execute your new cover calls or cash secured puts. And we give you a list of stocks, the expiration date, the strike price, the the raw return, meaning how much return are you actually receiving from selling this cover call, the annualized return on your cash if this doesn't get executed. And for those of you that are a little bit more advanced, we also included an implied vol rank and percentile. For those of you that want to use those types of metrics to help you find opportunities, you can use this report in so many different ways, but really think of it as a reminder to tell you after options expiration on Monday, that's when it's time to start generating yield. And we've built reports for you to help you find what is the optimal expiration date and strike price. And you can always log into Options Play, click on a symbol, and instantly see where is your starting point. And we really built this in a way so that it's as easy as possible for you. So with that, I want to thank you for taking the time out here this afternoon. I hope that you guys found this useful in better understanding how your own assets, the cash that you want to purchase your stocks with and the cash that you've poured into your stocks, how you can utilize that cash to generate yield in your portfolio. And more importantly, what tools are available to you at your fingertips to allow you to execute them. So with that, I'm going to open this up for Q&A. Just as a reminder, while you submit your questions into the chat window, for those of you that have not joined us as a member, you can join using this link here on your screen. Once you're past the 30-day subscription, the 30-day free trial, it's just $75 a month or $500 a year for our services, which includes the daily trade ideas that we send out, the weekly options education, the short put and cover call reports, and all of the recordings for our previously recorded webinars. So what I will do here is, again, if you have questions, please submit them into the chat window. What I will do is I will scroll up a little bit and I will look at some of the questions that were submitted earlier. Laura, I think you were the one that asked about not getting the report. So please send me an email at info@optionsplay.com. I will take a look at your account. Stan is asking, can't you use a synthetic cover call? Not sure what you mean by synthetic cover call. If you mean a synthetic stock and then selling a cover call on that, you certainly can. However, you don't have I don't know why you would do that, because you would have to put up the same amount of cash. You're now trading 3 legs of an option strategy. And if the short call gets called away, you don't have stock to deliver. So you either have to buy more stock to deliver it, or you have to exercise your long call to deliver it. You're just adding a lot more complexity that you don't need to do, in my opinion. Yes, you are obligated to buy 100 shares of the stock when you sell a put, which is why it's only a strategy for the stocks that you want to purchase. It is not a strategy for stocks that you don't want to purchase. Timothy is saying, can you eliminate the margin requirement by buying a far out of the money put? Yes, actually, Timothy brings up a really good point. Because selling a put, a put requires a fair amount of margin in order to do so, you can buy an out of the money put to reduce that margin requirement. But Timothy, remember, if their short put gets executed, you still have to come up with the cash to own that, to buy that stock eventually. So you can reduce your margin requirement to hold it, which would increase your yield if the put doesn't get exercised. But if the put does get exercised, you still need the cash in order to buy that stock. So very good point, Timothy. So for those of you that are looking to squeeze a little bit more out of that cash or yield to purchase the stocks, you can sell, let's say in this particular case, sell this 86.5 put, buy maybe $75 put or something very, very cheap that costs you 15, 20 cents. It reduces your margin requirement on the short put. But if the 86.5 put gets executed, you have to come up with the $8,500 to actually purchase that stock. Is it an obligation? I thought it's only an obligation if you're assigned. Yes, it is only an obligation if you are assigned. That is correct. Chris is asking, is there a risk of assignment prior to expiration? I'm guessing you're referring to the cash secured put. Well, I mean, I guess in any strategy, there's always the risk of assignment prior to expiration. I will say the risk is probably a little higher on the put side than on the call side. The only time it makes sense for someone to exercise a call early is to capture a dividend. So unless there's a big dividend coming up, I really don't see a good reason for someone to exercise a call early. On a put, sometimes a put can trade below intrinsic value, and that is the only time where typically you will see a put being exercised early, or someone just wants to sell their stock and they're happy to take a loss on the put. There's always the risk of early assignment, but that's why both of these strategies, a cash secured put and a cover call, you shouldn't mind if they get assigned early, because number one, that means you either purchase the stocks at a discount that you wanted anyway, or it means that you were able to take profit on your stocks early. So either one of those outcomes, in my opinion, aren't bad outcomes, right? Owning a stock at a discount and taking profits on your stocks are never bad outcomes. If I like to keep the profitability of expiring worthless above 80 and just play the yield, okay. Looks like Michael's logged out here. Jake asked a really good question. Should you wait for a pullback before selling a put? Jake, absolutely. If you want to be more tactical and if you wait until there's a pullback to sell a put, you will generate more yield, because pullbacks generally elevates implied volatility, so you get a little bit more yield on your puts. So tactically, yes, selling a put during a pullback, will generally generate a little bit more yield. It may lower the probability of owning that stock a little bit, because usually after a pullback, you have a higher probability of getting a bounce. So up to you, but if you wait for a pullback, you can be a little bit more tactical. Maura saying, you purchase the stock anytime before or at expiration when the stock hits the strike price. Maura, you purchase the stock anytime before or at expiration. Oh, Maura, I think you're referring to a cash secured put, and the answer is you purchase it at the expiration when the stock is below the strike price. So not before, only at expiration. Can you talk about the impact of the dividend? So the impact of the dividend really is not applicable in both cases, because until you own the stock, the dividend doesn't come into play. Once on a cover call, you capture the dividend because you own the stock. So as long as you own the stock, you keep the dividend. And that is generally why whenever we're selling these types of strategies, we want the cover call yield to be greater than the dividend yield. So on Philip Morris that pays a 5.32% dividend yield, you want to make sure that your cover call generates as at least that amount of yield, because if it generates less, what you're potentially losing is 5.32% yield on your cash. You don't want to lose that for something less than that. So, to go from 5% to 11%, that's worth it. But to go from 5% to 7%, that's not worth it. So you always want to use the yield as your barometer as to whether or not a cover call is worth it. Jurgen saying, that's cool, but what do you do if it goes against you? Jurgen, if you could clarify as far as what you mean by that. If you're talking about a cash secured put, well, you have the same problem if you place a limit order, right? So if you place a limit order to buy a stock at $95 and the stock drops to 80, what can you do? There's not much you can do other than the fact that you have to decide, do you still want to hold the stock that's 80? The only difference here is now, instead of being down $15, now you're only down maybe $13 because you collected $2 in income. So a cash secured put always puts you in a better position than if you place the limit order, but it doesn't protect you if the stock falls down, right? Because you, at the end of the day, that's a risk that you take when you own a stock, is that it can fall in value. And what can you do? You can buy a put to protect yourself, or you can just get out of the trade. Maura's asking, do you recommend buying a long call and sell cover calls against it to receive income? Yes, generally speaking, if you're buying long leaps to sell cover calls against it, that is typically known as a calendar or a diagonal. It is absolutely a strategy that I do recommend. However, just be aware that when you're selling cover calls against a long call, you don't have stock to deliver if the stock gets called away. So you either have to have enough cash to buy the stock to deliver it, or you need to exercise your long call, which means that you're going to lose out on the extrinsic value of that call. So be careful of that when you're doing that. Do you wait for the stock to resist for covered call and for support for, oh, do you wait for the stock at resistance for covered call and for support for selling puts? No, you do not. You can sell covered calls all the time. This is why we use probability to choose our strike prices. You can get tactical, but if you only wait till resistance to sell covered calls and you only wait till support to sell puts, then you're probably only selling maybe 2 to 3 months out of the year, and you're missing out on 8 to 9 months of income. So you can be more tactical and have a slightly higher probability of those calls and puts being expiring worthless, but you're going to miss out on maybe 75% of the income. So I don't recommend that. Does the annualized return for the cover call include the dividend? No, but we have a 12-month projected yield down here, which does. So both statistics are there for you. Wayne is saying, I've been following your examples along with my options. I'm on options play screen. I'm not getting the same recommendations that you are showing. So Wayne, what you want to do is you want to go to income settings at the bottom of your income tool, and you want to choose short, medium, or long term. I've chosen short term because of the things that we'd explained to you. And I've chosen aggressive for puts, and I've selected optimal for calls. And once you save those as default, you should see the same recommendations as I do. Does the tool provide the probability of not being assigned? Absolutely. So for every single strategy that you see, there's a probability of expiring worthless. So for this cover call, there's about a 79% chance that this call is going to expire worthless. So we have that statistic on both the cover call and the cash secured put. Okay, sorry, there's so many questions here. I'm trying to get to everyone's questions. There's a lot of them. Jenny's asking, what's the reason for limiting short term to be at least 20 days? So the reason is because generally speaking, anything less than 21 days, there's just maybe not enough premium in it. So I will say in our current environment of slightly higher volatility and zero commissions, you can go a little shorter. But usually if you go 7 days out, you might only get like 10 cents in premium. And a lot of times you might only be able to execute that trade at 5 cents because of the bid-ask spread. So there is diminishing returns as to how low you can go. And generally 21 days is the lower end of that threshold. Does the short put and cover call identify best candidates? So it identifies candidates based on the annualized return. So it gives you which one gives you the best yield. I guess best is subjective to each person because, number one, cover calls you could only sell on stocks that you own. So even if, ABMD, provides 20% yield, if you don't own that stock, you can't sell a cover call on it. So I don't really think it identifies best candidates. It covers the whole gamut so that you can find the candidate that suits you. For cash secured puts, again, even though ABMD generates the most yield, maybe you don't want to buy that stock. So you wouldn't sell a cash secured put on a stock that you don't want to buy. So what you want to do is you want to look at this list and say, which stocks do I want to buy? Maybe L Brands. This is a stock that was on my watch list. And I'm looking at this and I see that this generates a 5% discount on that stock purchase. So that might be how I would utilize this trade, so this report, okay? So cash secured puts, stocks that you want to buy, go down the list, see which stocks you want to buy, see how much discount you can receive, and then make a decision as to whether that's a cash secured put you want to sell. On the cover calls, it's really applicable for the stocks that you already own in your portfolio. Banu is asking, is the score on technical or fundamental? I'm not sure which score you're referring to. If you don't mind clarifying, I'm happy to answer that. Wayne, Boris, you're very welcome. Laura, did you put a link to the report in this chat? No, Laura, I will send you an email with the link, Laura. I'll take a look into your account and see why that's the case. Donald saying, could you show which stocks in the cover call report also have dividends in the next 30 days? So we currently don't have that, but I do have earnings date coming, and I can take a look at to seeing if we can add dividends to this report. So Donald, thank you for that input. We will take a look at that. Let's see. Bob is asking, please send the recording of this very valuable webinar. So we always send you the recording and the slides afterwards after each webinar. So look out for that. Is there a website to learn how to use your platform? So Ed, we actually have a full YouTube playlist of all of our webinars, and I've done quite a few of them on our platform. So I just sent the link to you in the chat window on how to access our YouTube playlist, which you can look at our platform walkthrough. That'll give you a better sense for how to utilize our tool. William, what do you think about Shamore's call letters cover call? I'm not familiar with that, William, so I'm sorry, I can't comment on that. Steven saying, what about rolling out cover calls to avoid assignment? Yeah, so Steven, if you want to roll a cover call, it's as simple as simply buying back the call that you own, logging into Options Play, seeing what is the new cover call that you should sell, and sell that one in a single order. So absolutely, if you don't want to own this, if you don't want to lose the stock, simply buy back the one that you own, come to Options Play, figure out what is the new strike that you want to roll it to, and that's how you can set up a roll strategy. Steve, regarding your question about SPX, I actually just had a call with SIBO today to figure that out. I hope to have a resolution by the end of this month. They're excited to have us to support SPX. But as you know, the data feed costs of those are extremely expensive. So I am talking to SIBO and hopefully having that resolved by the end of this month. Chris, how do dividends affect options pricing? So in theory, the option price is already the option price reflects that the stock will be reduced by the dividend amount during that time period. But as you can see many times that the stock trades right back after that dividend amount. So, but it is priced into the option that the stock price will decrease by the dividend amount on that dividend day. Wayne, I'm getting the same time periods but different strike prices about half the time. Also, I don't get an iron condor option when looking at all strategies. Oh, Wayne, I'm using options in first trade. So Wayne, this if you don't mind sending me an email because you're accessing it through a different platform, send me an email at info@optionsplay.com. I'm happy to take a look at that. Susan's asking, on a cover call, if the stock price goes up and near the dividend time, should you buy back the call or lose the stock? If the stock goes up and near dividend time, should you buy back the call or lose the stock? Susan, I'm not sure I really understand your question as to what the dividend has to do with it. The question is whether or not you want to take profit on your stock. So if you are okay taking profit on your stock, let it go. If you want to continue owning the stock for the dividend, then you should buy back the call. Steve, I'm happy to explain your diagonal spread, but I do think that it's a little outside of the scope of what we're here discussing here today. So if you want, send me an email at info@optionsplay.com and I'm happy to answer that question for you. Praveen, to answer your question, that's something we're working on, and we're gonna hopefully add that functionality over the next couple of months. Mora, for cover calls and reports, states 20 delta in your presentation. You recommend 10 delta. Which is it? So Mora, I would say that there isn't an exact delta, that because chances are you're never going to find an exact 20 or 10 delta. We do tend to find that anywhere in that 10 to 20 delta range is suitable. So on the cover call report, we target 20, but many times you'll see that it comes out to be 15 or 18. So it's hard to say an exact one. It's more of a range rather than an exact delta target. Shama, you're very welcome. Ted, what's the link for the options play optimal short put? I only get the optimal cover call report. Ted, if you get the optimal cover call report, then in the email, there's two links. There's one for the cover call and one for the short put. And if you can't find it, please send me an email at info@optionsplay.com. What's your criteria for the cover call report? So in the report, we actually tell you exactly what the criteria is. So we tell you what type of expirations we scan for and what optimal calls that we scan for. Is there a strategy for weekly options? So yeah, absolutely. So when you go to options play, look at the January 31st. That's a weekly option. From our perspective, weeklies and monthly options are all exactly the same. It doesn't matter. You know, if we're looking for a 30 days out, whether that 30-day option is a weekly option or a monthly option really doesn't matter. What's the difference between a 1 month and 6 month trend if both based on daily charts? They're just based on longer term indicators. So the 6 month chart is based on longer term indicators, and the 1 month trend, they're based on the same methodology, but the 6 month trend uses a longer term moving average than the 1 month trend. Does a valid bullish or bearish strategy for stocks should follow bullish or bearish if of related sector? So as a general rule of thumb, you want to try to find strong stocks in strong sectors and weak stocks in weak sectors. You may not always find that, but we do tend to find that if you are able to find the sector trend and the stock trend aligned with each other, you have a higher probability of the stock moving in that direction. Chris is asking, does time decay run the same if you have 7 days remaining of either weekly or monthly options? Yes. So regardless of whether it's a weekly or monthly option, if it's 7 days from expiration, 7-day options are the same regardless of whether it's a weekly or monthly option. Ronald's asking, hi there, if you do not own any stocks and do not wish to at the moment, can options play help with a way to make money? Absolutely. You could sell credit spreads. So Ronald, you can take a look at that link that I sent with the YouTube playlist. We do have webinars just on credit spreads, which is useful for if you don't want to own any of these stocks. It's really just a more advanced strategy of a cash secured put and a cover call where you don't own the stock or don't want to own the stock. Banu is saying score on the watch list menu. So the score on the watch list menu is this technical score. That's based on technical indicators. That's how we give you a sense for how strong the stock is compared to the overall market. So Smucker's score of 2 telling me this is a weak stock, underperforming the market. AT&T score of 8, strong stock, outperforming most of the stocks in the market. So with that, I think I've reached the end of the questions and I've gone over by about 10 minutes, but I want to thank everyone so much for taking the time out here this afternoon. I really think this is one of the better topics that we teach with options because I think this is a topic that almost every single one of you can execute. You know, when we talk about some of the spreads and things like that, not everyone wants to trade those strategies, but selling cover calls, selling cash secured puts, I would say 95% of you answered at the very beginning that you own stocks or ETFs in your portfolio. This is the strategy that 95% of you can start implementing in your portfolios today. The other strategies, not so much. So I really hope that you guys are able to take advantage of this, take advantage of the tools, the reports that we provide to help you execute these strategies. And thank you so much for all the words, kind words regarding options action. Thank you so much. I really appreciate it. I'm really excited to be on options action every single Friday, teaching more about options, teaching ideas. So I hope some of you are able to catch that. That's tomorrow evening at 5:30 p.m. If not, I will see you guys next Thursday. Thank you so much and have a great evening.